So, as Richard said, we've reached the point in the annual shareholder meeting where it's customary for the CEO to give a state of the company address, but we've decided to dispense with a formal presentation today in favor of a panel discussion with Richard Kellum and James Lorimer. My name is Paul Fitzhenry, and I serve on the communications team for DCM. I've got a list of questions here that will be of interest to investors and shareholders. And so I'll start with the first question to James. 10 days ago, we announced our first quarter results, and as part of that presentation, James, we talked about the sort of balance of the year priorities for DCM. And I wonder if you could just recap those again for those on the call and in the room.
Sure, Paul. We really have four key priorities for the balance of the year. The first is really making sure that we integrate the MCC business and really do it flawlessly. So that's really kind of our first priority. Second priority is putting in plans to grow our gross profit. As I think the audience knows, the business we acquired had significantly lower gross margins than our business had historically. And we're really looking at how do we get those margins back to the kind of pre-acquisition levels that we were. Third option or third focus is how we grow our business. And our commercial teams are spending a lot of time on, or I guess we spend a lot of time bringing our commercial teams together, working on strategic client plans to integrate our capabilities and cross-sell. And we're already seeing some of the fruits of our labor come there. So that's our third priority, is to grow the business. And then our fourth priority is to continue to generate higher levels of free cash flow. And if we do the first three things successfully, we think the fourth priority will certainly be achieved.
Great. Thanks, James. We'll delve into some of those priorities in more detail as we continue the discussion. Richard, it's been a year since the acquisition closed, April 25th. Of 2023, and there's been a lot of work put into getting us to this point today. Looking back on that sort of last year, if you will, anything stand out for you, things that might have been expected or unexpected as we've gone through that process over the last year?
I mean, it's a great question. We were very, very well prepared for this acquisition. We spent a lot of time on due diligence, and we used the Boston Consulting Group to help us through that process. So we really kind of understood what we were acquiring before we acquired. We spent a lot of time on pre-merger integration planning, and then we had a very detailed plan for post-merger integration, which we've been executing against. I've done several deals in my career, and this one, you sometimes find skeletons in the closet, you find some issues, but I'd say this one we found a lot more opportunities. Through the due diligence and through the pre-merger integration planning, we identified $25 to $30 million in synergies. Once we got into it and got into post-merger integration and execution, we revised that to 30 to 35 million in opportunities. And those are clear, hard. I call them hard synergies we can capture. And so we acquired a great business with a great team, like an exceptional team. Lots of opportunities for value creation as we continue to integrate the businesses across the country. But we acquired a great team with incredible capabilities, a great product, incredible clients, and now that we're one, I'd say we're working very, very well together. We still obviously have some integration work to complete, a few facilities that we need to close by year end, but all that work will be complete by the end of the year, and we'll be into a nice kind of clean year in 2025. So yeah, great question. I say, everything positive. Like, again, we were so well prepared going into it, and now we're executing the playbook that we wrote pre-acquisition.
James, growth. You mentioned growth earlier on the priorities and focus for a lot of investors, whether it be larger institutions or individual investors. after a transformative merger like this is top line growth. And what can you tell us about sort of how the leadership team views your top line growth opportunities and prospects going forward?
Yeah, thanks, Paul. We see a ton of opportunities for growth. Every day our commercial team is having successes, and whether it's new contract wins or contract renewals. We're also seeing some really interesting kind of new logos and expansion revenue within our existing client base. So lots of great opportunities coming through the pipe every day. We've talked about publicly a target of a 5% compound annual growth rate in revenue over the next 5 years. And we see, probably going to be focused in the early couple of years really on that gross margin improvement. And so we're not going to grow just for growth's sake. Focus is really on profitable growth. But we expect to see that kind of growth accelerate in the latter part of that next 5 years.
Let me just add to it as well that it's rare you get the opportunity to select an A team. So we went through the process of integrating, and we selected the A team for our commercial team. And we have a team that honestly is best in class. 63, 64 frontline salespeople are out there every day bringing service, bringing solutions. Right, we're a solution-based selling company, bringing solutions to clients. And really, you think about it, we came together as a commercial team October, November. We're really starting to really, get in our groove, if you will, right? It takes a couple of months working together and picking up new accounts to really, get that momentum. And we've got incredible momentum right now. Got, I walk around the office, I talk to people every day. I was up in Vancouver last week with our team. And there's a lot of great stuff happening now that our teams are together, really have the A team. And I'd also add that the market is good, right? When you understand the market, print market is good. You understand where to play and how to bring value to your clients. And that's exactly what our commercial team is doing right now. So we're pleased. We're confident in delivering our growth agenda, and we see a real bright future for our growth agenda over the next few years.
Just at this time, pause and welcome any questions, whether it be here in the room from anyone attending or online. So that we'll have that open for any questions. Okay, I'm going to come back to you, Richard, here. And obviously, this year is all about completing the integration after a transformative acquisition. But question may come up: what about future M&A? Is that in the cards at all? How do you look at that, given that you're still in this integration phase? But I'm wondering if that means that you're not looking at other opportunities down the road.
Yeah, obviously, as you already said, priority for us is just making sure that we digest this acquisition and integrate with excellence and complete all of the integration by year end and deliver the synergies that we promised. And again, we're on track to do all that. But leadership responsibility as well is to look at the future, 2025, 26, 27, and we're looking at the future. Not to say that we have any active M&A right now, but if we think of kind of the areas that we're looking at from an M&A perspective, one kind of pillar, one area is other smaller tuck-in opportunities that bring value to our business. So it could be companies that are do a lot of kind of highly personalized communication, direct mails, etc. So that's kind of an area that we're looking at. And by the way, the market is ripe for consolidation. We're getting calls every week from printers or printers out there that are looking to be part of our larger organization. Second area that we're considering at this point and exploring is a little bit more vertical integration. So think of marketing communication services, but not any marketing communication services, more kind of on that personalized communication space, which is, again, where we deliver a lot of value to clients. And the third area would be in the MarTech space. We've got a portfolio of a few MarTech solutions for clients, and majority of our workflow is MarTech or tech enabled. So opportunities for other MarTech solutions as well. So those would be the three areas that we're going to be exploring, but that's kind of the future after we complete the integration of MCC.
Well, speaking of integration, if we look at the sort of the capabilities of the respective organizations, DCM and MCC, coming into last year, there's obviously some things, I guess, as we're going through integration, where we see an MCC legacy customer being attracted to something that DCM offers, and vice versa for a legacy MCC or a DCM client being attracted to offerings that MCC has. Could you, James, share some examples of on both sides where clients may be finding things in the combined business that were not there before?
Sure. A few areas on the MCC side as well as the DCM side. With the Moore acquisition, we acquired some capabilities in transactional print. So think about high speed, high volume, personalized communications, statements and invoices that are going out on a monthly and quarterly and annual basis. So that was a great capability that we're able to now offer to some of our larger clients, and particularly where we're finding some traction there would be in financial services sector. We also got some great capabilities in the retail sector with the Moore team, and we're taking advantage of that with some of our own strengths in the retail sector. So think about some of our large format capabilities and some of our retail design capabilities. So we're really having there's been a great kind of coming together of ideas in the retail sector. From the DCM side, where we're seeing great kind of pickup from the Moore accounts would be in our large format business. The Burlington business that we acquired a few years ago has some great capabilities that they didn't have. They were actually outsourcing a lot of that type of work to third parties. So we've been able to kind of capture that outsourcing and along with that higher margins. We also have great capabilities in direct mail. That was not a previous focus of Moore. And we're taking that kind of capability set and skill set to the Moore team. I think another kind of important area is the Moore team was focused from a commercial perspective more on kind of their kind of product centralists. So they would have teams that could do a really good job selling commercial print or transactional print or business forms or labels. The DCM approach, and this is something that we really put in place, I guess over the last kind of 9 or 10 years, was much more of a solution-based selling approach. And so we've been able to kind of integrate that philosophy right across our full sales team now. So we're really going out to the market with a solution-based selling approach where we're able to offer a full kind of suite of services.
Richard, seems like today artificial intelligence is at the top of everyone's list, whether they're playing around with Chat GPT in their homes or starting to see the application in their business. When you think about DCM sort of today and going forward, where are the applications of artificial intelligence that you're sort of already maybe involved in, or things you may see down the road?
Yeah, so we're pretty active in the space right now. Got 3 areas. One would be in the marketing area. A lot of opportunities for automating creative services, as an example, and we're already kind of leaning in hard there. Of course, we specialize in personalized communication, and AI can allow you to now hyper-personalize that communication. So we're learning a lot and leaning in a lot on that as well. And then workflow optimization, right? Understanding data and information and applying algorithms to improve that workflow. And that's an area that we're using a lot of AI capabilities in today. So lots happening in the marketing front. On the operations side, a little bit more on the machine learning versus pure AI, but machine learning is part of AI as well, as you know, right? Algorithms allow for quality improvement. We're doing a bit of that in our workflow today, and then supply chain optimization as well. And then the third area, which is interesting, and maybe we don't think about this from an AI perspective, is and certainly our commercial team, our sales guys do, which is automating that prospecting, automating that commercial leadership, and we're using AI for script writing, we're using AI for prospecting, we're using AI for personalizing, email at scale as well. So lots of use in our business today, and learning a lot as we go. I'm sure most companies are learning as they go as well, but we see a pretty bright future as a result of some of the capabilities that AI brings.
And a competitive necessity going forward, right?
Yeah, for sure. Yeah.
Aim to go back to more of a mundane subject of debt. We took on a lot of debt last year with the acquisition, but reported with Q1 that we already made a substantial reduction in our debt over the last year. But can you give us a bigger picture on sort of how we're managing our debt going forward?
Yeah, sure. We take a pretty practical and we think conservative approach to debt. Prior to the acquisition of Fuller, we had about $20 million of net debt. So that kind of strong balance sheet really allowed us to finance the acquisition 100% with debt. And then we had a very strong plan in place to refinance and pay down that debt. So we made significant strides over the past year in doing that. Our longer term target for net debt to EBITDA is below 1 time. If you look at our first quarter report, we were 1.8 times on a trailing 12 months basis, 1 time. So 1.8 times net debt for adjusted EBITDA and a net of lease payments. And that's down from a little over 2 times at the end of the year, and certainly higher levels after we made the acquisition. So throughout the balance of this year, our principal payment will commence for some of the Fiera private debt that we put on with the acquisition. And then that'll kind of normalize at about $6 or $7 million a year. And then excess free cash flow, we will use that to pay down our revolving line of credit. So we expect to see that target of below 1 times net debt to EBITDA achieved over the next couple of years. Kind of a combination of growing adjusted EBITDA and also paying down debt.
Also successfully completed our plan around sale leaseback of some of the former MCC facilities as well, contributing to that.
Yeah, absolutely. As I think everyone knows, we had a kind of a short-term credit facility that was effectively secured against the 3 real estate facilities that were acquired as part of the deal. That $30 million facility was repaid, I guess, back in before the end of the year. And we subsequently sold and leased back the 3rd facility. So we've completely kind of refinanced those facilities and paid down that credit piece.
Right. I'm going to go back to one of the balance of the year priorities, which is improving gross margin. And Richard, I know you have a saying that gross margin can be your best friend.
No, gross margin is your best friend.
Is your best friend. Okay. Gross margin is your best friend. Okay. So how can we think about that? I know we talked a lot about sort of the 2 different businesses coming together, but sort of what are some specific steps that we're taking to drive that gross margin?
Yeah, maybe just to remind shareholders that weaving legacy DCM was sitting at around just under 30.8, 30.9% gross margin prior to acquisition, and up from about 22% 5 years ago. So really, knew how to create value in the market. And then we acquired MCC, and one thing we liked about it is the margin was quite low, right? So average margin at MCC was around 20%. So how do we apply the DCM margin model, if you will, to the acquired business, which is exactly the way. And we've got one objective, which is get back to 30 as quickly as possible. And you saw our results at Q1, we were more than right on 29. And but we now have a very clear, I'll say, profitable growth obsessed mindset in the business. So not growth at any cost, growth in line with the margin expectations we have. And that's coming through obviously understanding how to create value for our clients in the marketplace, right? The more value we can bring to clients, the more value we should get. It should be mutual, right? So we don't want to play in low margin pools or low value pools that anybody can play in. We have to bring something different to our competitor or to our clients rather versus what our competitors bring. And that's all what we call strategic revenue management, right? Finding opportunities to bring more value to clients. So we've done a complete review of our existing client base, as well as new opportunities in the marketplace of where and how we create value through. We call it again SRM, strategic revenue management process. And the commercial team across the country is kind of well skilled now, and we're starting to see the results. So we have a very, as said, I'll repeat it, gross margin is your best friend, right?
Yes.
And we want to have a best friend. We all want to have a best friend, right? And we're seeing that play through, right? Our commercial team, which is again, we've got the A team up there, knows exactly what the strategy is. How do we bring value-added services to our clients and extract, and get paid accordingly for it, right? And we're seeing success. And it's not growth at any expense; it's profitable growth. That's our mindset. Okay. And of course, all the operational consolidation that we're going to be doing and that we're doing right now will also obviously improve. Right? The key drivers of you think of the key drivers: gross profit, its mix, its pricing, and its operational excellence. Those all contribute to driving that gross margin forward.
Okay. Well, speaking of sort of products and services, I know you're excited about some of the progress we're making on the digital front. Maybe it's 2 or 3 examples of things that excite you in terms of making inroads in digital.
Yeah, I mean, there's a lot that excites me. First, sort of linked to what I just said in terms of gross margin improvement, where we create a lot of value for clients is where we manage a lot of complexity, right? And we work to simplify that complexity with technology. That's where you can extract a lot of value. And a big part of our business is exactly that, right? And we've got a fantastic platform that the team has built over a number of years called DCM Flex. And we call it DCM Flex because it does a lot of stuff: workflow optimization, print on demand, logistics and fulfillment management. But there's one particular piece of Flex that we're really leaning in hard to right now, which is a customer communication management portion of Flex. So think of kind of highly personalized communication at scale. If you're a large insurance company, you've got thousands of brokers across the country, and those brokers need to automate and personalize email distribution or communication. The platform allows us to do that, right? And same thing if you're a bank or an investment firm and you've got private wealth advisors around the country that need to personalize communication, hyper-personalized communication scale. That's functionality we have in our DCM Flex platform that we haven't really pulled out until recently to sell that as a service. And we've had some great success recently with our digital team. We picked up 3 new clients in the first quarter, just on that CCM portion of DCM Flex. So we're very excited about that. I mean, as I said, Flex enables a lot of workflow and drives that customer leadership agenda for us. But the other digital solution that we're very excited about is our digital asset management solution. To remind shareholders, we've been playing, the DAM market is about a $6 billion market globally, depending on what data you look at, 15 to 20% growth. And we've entered the DAM market a couple of years ago on what I call crawl, walk, run. Crawl, just learn about the DAM market, bring solutions to clients which have been our white labeled solutions. We've taken another DAM provider and labeled it into Assemble. At the same time, we've been building our own solution, right, to have our own tech stack and our own technology. And we're really excited because we're launching that July 15th. And back to your question earlier about AI capabilities, it's got a ton of AI capabilities built into it. And we're really excited about bringing that to market. Our first focus is on our 400 enterprise clients. Very few have a DAM today. They're using SharePoint, WeTransfer, Dropbox, hard drives, whatever. So files are all over the place.
Or I think the other thing is parts of companies may be using a DAM, but there may be a lot of other areas in the company that could use a DAM that may be a prospect.
That's a good point. They don't have an enterprise DAM, right? And ours is designed for enterprise, multiple file types. So ours is designed to make it super easy to upload, to find, to share, to distribute, and using all kinds of AI capabilities to be able to do all that. So we're really excited that comes to market. So call that our Flex DCM piece, which is we kind of pulled out of Flex and very active from a commercial leadership perspective, and then really excited about our entry into the DAM market.
I also think digital signage is an area that we're creeping into as well.
Yeah, that's right. We had a lot happening. That's a good point. We entered the digital signage business in August of last year, again on a very methodical crawl, walk, run. We didn't want to run straight into it. So you got to learn about technology and servicing and workflow, et cetera, right? And we picked up a couple of clients. Actually, one of our sales leads picked up a great client early on, like September, October. That allows us to kind of crawl in and to learn about our solution and how to service that solution. We're working with a great partner. They're based out of New York, actually, for the technology as well as for the software to be able to support the technology and to distribute content to screens. And then I'd say we're now in the walk phase. We picked up a $1.2 million client in the automotive space, 200 dealers across Canada. And that was all executed in February, March. So you can walk into the dealership, you can see the solution that we provided. And then we've got a very full pipeline. So still in walk. We don't want to put a number to it and give guidance on what that could be because we're still learning. But once we get to run, we'll put a hard number in and let shareholders know what our definitive plans in the future will look like. But we're very excited about our entry into digital signage.
Great. Just pause one more time to see if there's any questions coming in or anyone in the room.
Just a short question on the assemble. So how are you going to launch it in July? I know you don't want to give numbers probably, but what sort of ideas would you have or to deem a success, say, over the next 12 months? Signing up a certain amount of clients or getting in front of a certain amount of your top tier clients to present, or how you measure success?
I'll just repeat it in case those online may not heard. It's a question about Assemble and what the first 12 months and the approach to launch might look like.
So our main focus on launch will be our top 400 enterprise clients. We already have the routes to market. We've got 63, 64 frontline commercial leaders that are out there talking to clients every single day. So we'll quickly amplify and get this conversation started. I don't want to give a guidance in terms of what our conversion expectations are at this point, because again, like our digital signage, like what we've done in other areas, the crawl, walk, run, we're crawling our way into it with incredible technology. And we think that'll accelerate pretty quickly. But it takes time, right? It takes time on digital like the sales cycle is a long sales cycle, especially at enterprise. It's a lot shorter when you talk about small and medium size, but small and medium sized organizations don't necessarily have the same problems that a large enterprise will have. So getting in, having the conversations, longer sales cycles. That's why I don't want to put a hard number to it, Chris. But we're excited about what we've got. It's very unique and differentiated versus some of the competitive product in the marketplace. It's not built on a folder structure, as an example, which adds a lot of complexity even within a DAM. Because of the AI capability we built into it, the ability to find files is instant. Ours also has a capability. Imagine you've got a 200-page presentation. Ours also has a summary. It will summarize that presentation to determine if you want to even go and download it or look at it. So lots of AI capabilities built into it, which allows us to differentiate, be somewhat unique in the marketplace. So yeah, main focus is going to be those 400 enterprises. We also have built marketing automation into our website as well for kind of geographies outside of Canada. But yeah, I'll give you a better idea once we get through crawl and into walk, just like I did with our digital, a little digital venture. But we're very optimistic. The one thing I will say, we know the DAM space. We know it well. We're practitioners. Every single day, we're managing tens of thousands of assets for clients, tens of thousands. And in our journey to DAM, as we've been building our own technology, we've won some large enterprise dam solutions using a white label solution. Why would they buy a white label solution from us when they go buy it directly from the from the provider? Well, they bought it because of our practical experience. And I can tell you a large, I won't tell you who the client is, but a large transportation client. We were up against competitive dams, and we won in an RFP in a competitive shootout. About a $250,000 client that we're actively working with right now. Again, using our white label solution. We'll eventually switch that to our own, tech stack. But it proves that we know the market, we know how to win at enterprise level, and now with this technology that we've built, we're quite excited about the future. So, not a direct answer for you, Chris, but I get a better answer once we get into it and get into Blockface.
I know one of the things you hear from clients is that this is a pain point now in terms of managing all this explosion of content. We've got so many more creators within organizations creating content.
Sure.
And therein lies an opportunity to solve that pain point, right?
It's a huge pain point. And listen, it was a huge pain point for us at DCM. We got 60, 65 salespeople out there that are creating content every day, right? They're creating presentations every day. How does the guy in Vancouver see what the guy and the girl in Halifax has done? How does the team in Ottawa understand what the team in Toronto have done? Everything goes into our DAM. I love it because every morning I wake up, I switch it on, I can see what the team has done yesterday, right? And so we have it's really at the heart for us here at DCM for collaborating and sharing and driving efficiency and productivity, right? Time to find, time to share. It's a huge pain point. We solved it quickly because obviously, we wanted to be the beta, and I can tell you it's an incredible tool for us.
Great. We'll go ahead and wrap up. There's no further questions. Thank you for your interest. I hope that there was some insights here about the business from James and Richard that you maybe learned today. And obviously, the door is open, James, Richard, for additional questions, conversations with shareholders and investors going forward, and follow up with mid-year results in August, James, correct? That's right. Yeah. Great. Thank you again, everyone, for your attention for this panel discussion, and have a great day.
Thank you, everybody.
Thank you.